We're putting gold on the sidelines today to talk to a known analyst in the energy metal space. What can investors expect from uranium and lithium? Joining us now is Chris Barry. He's the president of House Mountain Partners, and he's also the co-editor of the popular newsletter, the Disruptive Discoveries Journal. Chris, thanks for joining us in studio.
Thanks for having me.
Now, I know we're going to talk uranium and lithium. I know you say you're not a gold guy, but last time we spoke in March, we spoke gold, and you were eyeing gold at 1,300. Before we move on from the metal, what are your thoughts on the yellow metal right now?
Well, my opinion really hasn't changed from the last time we spoke. When you have a situation where the countries comprising 25% of global GDP are operating in a negative interest rate environment, I think that says a lot about why gold has taken off year to date, and I don't see any reason why that wouldn't continue.
So that's quite a bullish forecast for gold, then, right?
I think it's bullish. I mean, I'm a little hesitant to really, call a specific price, but as long as you have a situation where the global economy is struggling for growth and investors are looking for yield, I see gold as the primary beneficiary there.
Well, you're also bullish uranium, and that's what I want to talk to you a little bit about today, and make some counter arguments because, a lot of investors don't want to touch uranium because, it brings up, feelings of radioactivity,
Sure.
Nuclear comes to mind. So investors are fearful. Well, what's your counter argument to this?
Well, when you look at the global energy or electricity supply, every source of energy has its own pros and cons. For example, coal is very cheap and very energy dense, but of course there are longer term environmental impacts and also impacts to public health. Same thing with respect to uranium. You've got pros and cons. It's by far the most energy dense source of baseload electricity out there. So, in the wake of the Paris climate agreements, where you got 195 countries, I think, to basically loosely agree to decarbonize their energy source, uranium is going to have to play a significant role in that mix.
So what's your price forecast? Where do you see it headed?
Well, I think out over the next 18 to 24 months, you could see uranium prices that are 30% higher, okay, from where they are today. And a lot of that has to do with the fact that you have utilities that have not been in the market over the last couple of years securing long-term supply. They're just basically waiting for prices to continue to fall in the wake of Fukushima. But I think we've hit bottom in the uranium market, and I think out over the next, again, 18 to 24 months, the utilities will start to come back in and put a little bit of pressure on the uranium market. And also, let's not forget China. China itself is building, I think, 24 reactors as we speak. And so, that's going to be a significant source of demand going forward. By my estimates, China has imported 50 million pounds of uranium in 2014 and 2015. So I don't necessarily see that tapering off.
And how are you investing in it?
Well, in terms of playing it, it's been very tough because when you have spot uranium at $28 and the term price at $44, there really aren't any uranium, well, I shouldn't say any, but there aren't very many uranium plays that are making money right now. And so I think the way to play it today and going forward is through M&A. When you look at the structure of the uranium market, it's really an oligopoly. You have 4 primary producers, and they produce about 2/3 of global supply. Okay, and so if I'm an aspiring, if I'm a uranium development play or an exploration play, I have to have the lowest cost of production to be able to compete in that oligopoly. And so I think that it's those companies in the Athabasca Basin, for example, that are going to be well positioned going forward.
All right, let's look at lithium now, because I looked at that chart this morning and said, wow, what a run it's having. Is it really just a Tesla play here? And I know you also say, maybe we should be a bit cautious around lithium. Why is that?
Well, it's a small market. It's similar to uranium in the sense that it's an oligopoly. It's really run by 3 or 4 or 5 companies globally. And yeah, the price has absolutely gone parabolic. And I can tell you from my experience in the energy metals over the last 6 or 7 years, anytime you see prices go parabolic, it usually ends in tears. And so you just want to be very careful right now about how you approach the lithium space and where you invest. It is very much a Tesla story. You're starting to see wider adoption of electric vehicles. You're starting to see battery costs, lithium-ion battery costs fall. You're starting to see renewable energy deployment outpace other sources of energy. So it's a good long-term story, but it's been a huge run over the last few months.
Chris Barry, thanks so much for stopping by the studio.
Thank you.
And thanks for watching. We're switching gears back to gold with Peter Hugg up next.